Welcome to this video on cost accounting and cost analysis. We are going to cover the topic of cost accounting, which means allocating cost of providing services to mission centers. We are going to have two examples, one involving non-personnel cost, and here we have the example of the Hoosier County Road Department. And note that this example is available in a separate video. And then we also have the example of the Hoosier Police Department, where we are looking at the personnel cost in determining of how many police officers and how do you budget for police officers. And that is also in a separate video that you can find by clicking on the link. At the end of this lecture, we are also going to talk about the break-even analysis, and we are going to use the example of garbage collection. Now, first, have a look at the difference between cost accounting and cost analysis. Basically, cost accounting is to classify financial information from a budget or from a financial report into various cost categories. Usually, those cost categories are mission centers to provide services to the public. Now here I have a definition of the Oregon Accounting Manual from the Department of Administrative Services, and it says for cost accounting that a method of accounting which provides for assembling and recording all elements of cost incurred to accomplish a purpose, to carry on an activity or operation, or to complete a unit of work or specific job. Now note that this is slightly different from cost analysis, which actually uses cost data to determine the cost and evaluate how changes in the cost would actually affect the operations of an agency. Note that cost analysis also can determine whether we have to change the operations in order to become more efficient. Okay, you can think about cost analysis as a decision tool for service contraction or service expansion. Now, let us have a look at certain terminology first, specifically to differentiate the terms obligation, outlay, and cost. Note that although those terms seem very similar to each other, there are some nuanced differences. An obligation is basically taking on the responsibility to meet the terms of a contract. Here you can think about if you are a city agency and you are purchasing a road salt in June for delivery in October. So maybe you are signing the contract for the road salt in June and your payment may be later at some point, and also the delivery may be later, but you are incurring the obligation to purchase the road salt. The outlay is actually the physical outflow of cash. So for example, staying with the example of the road salt, you may be able or you must pay for the road salt in September. So when you have the physical transfer of money from the agency to the provider, then that is called an outlay. And then lastly, you have the cost. And that is actual use and the consumption of the resource. So staying with the road salt example from before, then think about you are getting the salt in October, but you are using some of the salt in December and you are using some salt in, say, January and February. Then the consumption is going to be occurring in December, January and February, or it may, and you may be able to spread out the cost over two different calendar years. Now note that there's also a difference between operating cost and capital asset acquisition. Again, the operating cost is what we have in the previous slide, in the previous example with the road salt, where you usually have small differences between obligations, outlays, and cost. And that has to be differentiated from capital assets. So usually if you're purchasing a large capital asset, think about the road salt example here, when you're actually purchasing the truck to spread the salt on the road, then that investment is spread over multiple years. And you also have a multi-year consumption of that asset and also depreciation. Okay, so here we may have the outlay. We may have to outlay the physical outflow of cash when we are purchasing the asset, but then the cost is going to be spread over multiple years. Now let us analyze or have a look at cost accounting. Again, the goal of cost accounting is to actually assign the cost of services or the services provided to categories that are useful for cost analysis. So here, in order to do cost accounting, you can base your decisions on past budgets, on operation reports, on contracts and billing statements. Basically, you have to determine the various mission and service center associated with your agency and then allocate the cost that your agency encounters over a year to those various mission or service centers. So for example, if you are the Department of Transportation, then you may have a mission center that is called road maintenance. Then that you would have to, then cost accounting can then help you allocate cost to the road maintenance mission center of your department. Usually as an agency, you have a direct cost and indirect cost. So direct cost are costs that can be specifically assigned to a service. So for example, if you are repaving Meridian Street in Indianapolis, then the asphalt that you are going to use to pave the street, that would be a direct cost. You also have indirect cost, and here the indirect cost cannot be specifically linked to, for example, paving Meridian Street in Indianapolis. So for example, think about the salary of the manager handling road maintenance in Indianapolis or in Marion County. Then you have to somehow find a way to allocate that salary to various mission centers. Okay. And so one mission center or one part may be, for example, the repavement of roads. Cost accounting, the overall goal is to allocate or to convert indirect costs, such as the salary of the manager, into direct costs that can be attributed to a mission center. And when you are watching the video on the Hoosier County Road Department, that is where you are seeing one technique of how you can actually accomplish that. When we talk about cost, we also have to differentiate between different types of cost. So here we are going to look at fixed cost, variable cost, semi-variable cost, and step cost. So think about you're providing a service to the public. Now note that those terms that I'm about to explain here can also apply not only by providing service to the public, but can also be services to a specific industry or a firm or a private industry. So you have a fixed cost, and those fixed costs are, well, they are fixed and they do not vary with output. Note that here, those fixed costs are also costs, or you also have to spend those fixed costs even if your output is zero. So if we are taking an example from private industry, for example, you have a shoe store and you're selling shoes. Even if your shoe store is closed, you still have to pay the rent for the space. But it doesn't matter how many shoes you are selling, the cost is still the same. Then we have variable cost. Now the variable cost varies with the level of output or with each unit of the good or service provided. If you're thinking about the example of road maintenance, then if you're paving more roads, you need more asphalt. So the asphalt would be a variable cost. Then there are also semi-variable costs with that have a fixed and a variable component. Suppose that you are working in an office and you are actually, say, renting the copy machine, then most likely you are going to have to pay a fixed cost and also a variable component depending on how many copies you are actually making. In the example of the Hoosier County Road Department, the equipment to actually maintain the roads. That has a variable component and also a fixed component, where the variable component varies by how many miles you are actually maintaining. And lastly, we may have step costs, where it varies with output but with discrete jumps. For example, if you are a school district, then you can, if you are serving more students, you may not need to hire additional teachers. But for every 20 students that your school grows, you may need to hire an additional teacher. Okay, so hence that would be an example of the step cost. Now, if we are looking at cost accounting, that there are steps involved, and we are going to have a look on the subsequent slides here what the steps are. So first we have to identify the mission centers. Then we have to identify the activity and the output units. We have to identify expenditure categories. And then we also have to identify allocation factors for indirect cost. And lastly, we have to link the cost to those mission centers. Now, the slides that I'm about to show are covering those aspects theoretically. And then when you're actually looking at the or watching the Hoosier County Road Department video, that is where we actually have the practical application of the theoretical aspects here. First, in the first step, you have to identify the mission centers. So those are basically the parts of the organizations that provide direct service to the public. So if you are providing separate service, then you have to develop a unit cost for each service provided. Usually, those mission centers also serve as a basis to determine user charges or reimbursement rates. So for example, if you are a water department, then you may have two mission centers in the simplest case, where you have a mission center that is associated with the distribution of water, and you may also have a mission center that is associated with the treatment of water. Okay, basically the cleaning. You may also have, say, a sanitation department where you are collecting garbage, which may be one mission center, and then the disposal of garbage may be actually a different mission center. In the second step, you have to identify the activity and the output units. Okay, because remember that one of the key objectives of cost accounting is to actually calculate the per unit cost. So you have to identify those units by mission center. It is important that those output units and the activity are actually measurable activities. Okay, and you can think about, for example, if you have to determine the activity or the output units for a nursing home, a garbage collection, water department, or a police department, right? So if you're thinking about those examples, then there may be differences in how you determine the output units. In the example about the police department, which again is in a separate video, you see that, for example, the output unit would be the number of, it could be, for example, the number of patrol cars that are patrolling the city. Then in a third step, you have to identify the expenditure categories. And again, here we usually have two large categories. We have personnel expenditures that are direct personnel expenditures such as salaries, but we also may have fringe benefits. And then we have non-personnel expenditures that are associated with the supplies, the equipment, utility charges such as water, natural gas, or electricity. And also you may need to pay for the facilities. For example, if you are renting a space, then those would be non-personnel expenditures. Now, I mentioned before that you have indirect cost, and you somehow have to link those indirect costs to mission centers. And note that here I have one example, or in this table you see one example, but there may also be different ways of doing it. So think about, you have the indirect cost of, say, the head of the department. Okay, so that would be the overhead, and then you could theoretically link that that position to the based on the personnel, or based on the full-time employees that are associated with that director's position. So think about, you have a director and they earn say $100,000, and there is a total of two departments, and one has 70 employees and the other department has 30 employees. Then you could allocate the salary of the director, the $100,000, $70,000 to one mission center and $30,000 to the other mission center. Okay, but there are various ways of doing those allocations. Then the last step, you really have to link the costs to the various mission centers. In an ideal case, you have only direct cost that you can then directly associate with the various mission centers. But in reality, you're going to have indirect cost or overhead, and then you have to use the allocation factors, which you have developed in the step before, to actually allocate those indirect costs to the various mission centers. Now note that here the Hoosier County Road Department, that this is again a different video, but I'm giving you the introduction here of what we mean by the cost allocation or the cost accounting based on the steps that we have just seen. So consider that we have this Hoosier County Road Department, and their mission is to actually maintain the county's road. Note that all personnel works full-time, and there are 225 days per year. The maintenance personnel, they receive the same salary and fringe benefits, and that totals about $74,000 per employee. Note that this department is not responsible for constructing new roads, but it is actually the Department of Transportation from the state that is constructing new roads. And in addition, the state actually reimburses the county for each mile of road maintained. Now here, in this particular case, we actually have two different types of road in the department, in the county, in the sense that we have some paved roads, but we also have some gravel roads that are left. In this case, we think about maintaining 80 miles of gravel road and 185 miles of paved road. Now here you have the parameters associated with the two mission centers, gravel and paved roads. Again, we are repairing 80 miles of gravel road and 185 miles of paved road, and the supply expenditures associated with those two mission centers are $41,000 for gravel and $180,000 for paved road. Note that here you have the cost per mile, which is simply the 41,000 divided by 80 and 180,000 divided by 185. We are also employing 9 people in total, 5 for maintaining the gravel road and 5 for maintaining the paved roads. The state reimburses us on a per mile basis. They pay $6,250 per mile maintained of gravel road and $10,020 per mile maintained of paved road. Okay? And you also have here the productivity factors associated with the maintenance. Now, since we have the $74,000 of the maintenance employees, we know that we can link them directly to the two types of road, because we have 4 and 5 associated with gravel and paved respectively. Now, where it gets a little bit more complicated is if we have the director's salary of $96,000, the assistant salaries of $61,000, and also a maintenance facility for $210,000. Note that those 3 indirect cost items serve both the gravel and the paved road. And you will see that we are going to allocate the director's and the assistant's salary based on the number of full-time employees associated with the two mission centers, and the maintenance facility, the fee, is going to be allocated based on the number of miles repaired. But more on that in the separate video. Now, the last topic that we are going to look at is the so-called break-even analysis. Now here we are going to consider a garbage collection service, and suppose that we have a city that is collecting garbage containers, and the collection fee is $2 per 96 gallon container. We have an annual fixed cost of $35,000 and $85,000. That is administration, that is associated with administration and the equipment lease. But then we also have a variable cost per container collected, and that is $1 for the landfill charge, that means dumping the garbage, and also 40 cents for the equipment operation. Now the question is to determine, well, how do the total revenue, fixed cost and variable cost, how do they vary with the containers? Here we have the current landfill charge. LF stands for landfill, and we have the new landfill charge. Note that the landfill charge increasing to $1.30 does not change the number of containers collected or the collection fee, which is still going to be $500,000. It does not allocate, or it does not change the fixed cost. However, it does change the variable cost, which now increases from $350,000 to $425,000. And whereas with a landfill charge of $1, we made a surplus of $30,000. Now with the new landfill charge, we are actually making a deficit of $45,000. Okay. Note that the surplus here you can calculate by adding up by taking the revenue minus the fixed cost minus the variable cost, and you're getting the $30,000 in surplus. And you do the same for the new landfill charge, and you're getting the $45,000 in deficit. Now here on a container, on a graph, we have actually the break-even plot, where on the horizontal axis we have the number of containers in 1,000, and then we have the surplus on the vertical axis. And the break-even point is basically where the number of containers where you're going from a deficit to a surplus. If we assume the old landfill charge of $1, then you can see that the break-even is at 200,000 containers. Okay, so here we have the green line, which represents the revenue. We have the blue line, which represents the cost. And note that the cost has the fixed cost of $120,000, which is right here. And it's a fixed cost that actually gets spread over the containers as much as that when we are increasing the number of containers collected. And here on the red line represents the profit and loss, and you see that at 200,000 containers, we are starting to go from a deficit into a surplus.